ESG investments have grown quite substantially over the past few years. To talk about some of the key trends that we see in this space, I'm joined today by Mike Tyrrell from SRI Connect. Mike, thank you for joining the discussion.
Thank you for having me.
So Mike, let's talk a little bit about what asset managers perceive about data that is being reported by companies on the ESG side. Ernst & Young recently conducted an institutional investor survey, and a phenomenal 60% of the respondents felt that companies aren't actually disclosing all ESG risks that are relevant to their business. Now, given some of these gaps that we see in information availability, how do you think asset managers are going to cope up with something like this? Do you think it will encourage asset managers more towards bespoke research providers? Do you think that's a trend that will pan out?
Well, I might start by being a bit controversial and say that whilst asset managers do complain about the quality and quantity of sustainability information they receive from companies, they probably complain a little too much. In fact, you'll see that a lot of companies also complain about the excessive information they have to provide on these subjects to asset managers and that isn't ultimately used. The problem is that over decades, both sides have flung insults at each other across barricades or just across bureaucratic disclosure initiatives. Where I think we need to move forward is for more direct contact between companies and asset managers, but also better analysis and insight between the two. So I do think that asset managers will turn to independent research providers, sometimes because those independent providers can get better and cheaper access to information about companies than the asset managers can themselves. But I think more because the independent specialists can get the depth of insight, the local market knowledge, the sector or issue specialism that the asset managers want. So data will prove part of the piece, but I think the local and specialist insight will be more significant.
Absolutely. Yeah, that makes a lot of sense. There's been a significant growth in green bonds issuance over the past few years. In fact, in 2016 alone, green bond issuance touched about $90 billion. There are significant growth projections going into 2020 for ESG bonds. How do you think green bonds will impact ESG investing in general? And more specifically, how do you think green bonds will influence ESG investing in the fixed income space? Would also like to hear about your thoughts on some of the fixed income indices that have been introduced in the market. How do you think those will pan out?
Yeah, sure. Well, I'm not a green bond specialist, nor really a fixed income specialist, but I do think that green bonds have brought useful and interesting momentum to the sustainable investment space more broadly. I think in fixed income, they've had the very interesting effect of bringing energy and, of course, money into the space. And I think some of this energy and money will leach across into the wider analysis of how environmental and social issues affect other fixed income instruments. So I think they've been very supportive of an existing trend towards the application of sustainability and corporate governance factors to fixed income. But I think it goes more broadly than that, because I think green bonds also encourage infrastructure investors to look at sustainable investment opportunities, and I think they also encourage banks to look at the climate change and environmental exposures of their balance sheet. Now, this is something we're going to see much more interest in on the back of the Task Force on Climate-Related Financial Disclosures. So I think the broader understanding of lenders and bond investors in sustainability is going to grow. And then I think for equities, there's also a knock-on effect, because the information that is used to clarify whether a bond is green or climate resilient or has sufficient mitigative capacity, and also the processes that we go through to make those definitions, will be used again in equity investment as well.
So let me approach the topic from a slightly different angle. With MiFID coming in now, Mike, how do you think the introduction of MiFID regulations early next year will pan out for ESG research in general? And how do you see asset managers coping up with their demands for ESG research once the MiFID regulations come into play?
Well, if I could start with the second of those, I think MiFID is a huge challenge to asset managers, not only in Europe, where the regulation affects, but also around the world. But I think it's an exciting one. I think it's probably a once-in-a-generation opportunity for asset managers to sort out their research supply chain. And within that, opportunities will arise for SRI and corporate governance investors.
Why do you think it's a once-in-a-lifetime opportunity? Why do you say that?
Well, once in a generation, because when I started work on the sell side, one of the first things I was told is your job has a limited shelf life. Commissions are going to go, sell-side research will go. And I had a good career in the sell side and have moved on since, and it still hasn't happened. But it looks like it's going to happen next year. Asset managers are going to be required to take more responsibility and more ownership for their budgets.
Do you think it could be an opportunity, or one last opportunity, if we actually don't make use of it at this point, then potentially the impact of it or future changes could actually take a fair bit of time to come to be implemented going forward? Do you think?
Yes, absolutely. I think if fundamental asset managers don't do it this time, then passive investment will eat the business. Unless they sort out their bloated research supply chain now, they will lose out to passive. So this is the chance.
And what is your view on sustainability and governance research around this particular aspect?
Well, I think it has a huge opportunity for sustainability and corporate governance research, not least because it puts that type of research on the same platform and on the same basis as mainstream investment research. Now, the situation with sustainability and corporate governance research at the moment is a bit of a paradox, because there's massive oversupply in the market. There always has been, there always will be. But at the same time as there being massive oversupply in the market as a whole, there is a lot of excess demand for very targeted, bespoke, insightful research that helps asset managers make investment decisions.
Right.
So we have this paradox between oversupply and excess demand. How do we resolve it is, of course, the question. It has to come from the demand side. It cannot be supply forced. Ultimately, the situation will only resolve once asset managers take responsibility for the research they buy and the research they ask for. I think when you consider it, it's slightly implausible that they don't. Using only one source of research is like a school child writing a history essay based on only one textbook. It doesn't count. So I think if we look ahead, sort of maybe 3 years into MiFID, to see what asset managers will be doing, I think it's realistic to expect that all asset managers that want to be taken seriously in sustainability and corporate governance will have one or maybe two waterfront research suppliers. Alongside this, they will have a panel of approved 5 or 6 specialist research providers, perhaps in particular markets or on particular issues or with particular sectors. Beneath this, they will of course have their own in-house capacity. I should have said that up front. They will have an in-house capacity that's able to understand what research is needed and to make sense of it when it comes in, to apply it to investment decisions. So on top of these sort of 3 areas of capacity, they will probably also have a bespoke research budget that they will have control of, but also accountability for, to pick up on those areas that the first 3 don't need,
right,
to enable them to seek proprietary insight, to commission specific research. This is why I think it's an encouraging time to be in the SRI research market. Yes, there is going to be challenge, because MiFID will undoubtedly put pressure on research budgets overall. But it will put SRI and corporate governance research alongside mainstream research, and it will encourage asset managers to be good and active buyers of that research, which is why, and I think that's what all research providers want, good and active buyers.
In the past few years, impact investing has come about in a big way, and it has added a very interesting dimension to ESG investing in general. At the same time, it has also challenged the traditional outlook towards investment practices. But one of the concerns that investors have is there isn't enough information which is available in the public domain to be able to identify a lot of these impact investment opportunities. What is your take on it? Is this something which will inhibit the growth of impact investing going forward? How do you think it's going to pan out?
Well, I think we have to look at impact investing through two different lenses. I think you have impact investing itself, and then you have the analysis of the impact that equity investments have. And they are 2 different ends of the spectrum. The former, the impact investing, is not an area that I'm particularly strong on, but I think it is undoubtedly growing. It is undoubtedly and very clearly attractive to certain investor groups. The second, the communication of the impact that the social environmental impact that equity investments have, is, I think, generating some real interest in the sustainable investment community. And it's something I feel very positive about. I think it stands to reason that SRI investors should demonstrate to their investing clients why they are having an impact. That is the point of these funds after all. And I think some intelligent work has been done to use the Sustainable Development Goals as the reference framework against which that impact can be measured. And there's some great work out there starting to work out how impact can be managed with reference to these goals. So I'm very encouraged about that. Of course, we do have to be careful of mission creep, because we have to ensure that we don't consider investing in a mineral water supplier to restaurants in San Francisco as meeting the demands of Sustainable Development Goal on water and sanitation.
Right.
So I think we have to be careful about that temptation. The other thing that I think we have to be careful about is recognising that impact investing per se, where there is clear intentionality, where the social and environmental objective is part and parcel of the proposition, is at a different end of the spectrum from impact through equity investments, where the impact is a positive, a byproduct, and a co-product, but not the pure intentionality. So broadly, I'm comfortable and confident about the growth of impact and the analysis of impact within equities, but I do have those points that we need to watch.
Understand. Mike, GIIN recently conducted a survey, and a staggering 75% of respondents actually said that in order to measure investment performance, they are more or less using in-house metrics or in-house frameworks for that matter. Do you think the lack of a homogeneous framework across asset managers, is that something that will likely impact the growth of impact investing going forward?
I think in the long run you do need recognised frameworks across any investment strategy. However, I'm always nervous about imposing frameworks too early on the process. And I think we lose if we try to do that, we lose some of the quality of SRI and impact investing, which is, of course, about innovation and experimentation. So I think at the moment I probably am more of the let 1,000 flowers bloom mode, whereby lots of different people should try lots of different measures and metrics, and over time those can be consolidated. I'm a terrible believer in markets. And I believe in bottom-up markets, and I usually get very nervous once people start trying to impose top-down frameworks too early.
Perfect. Right. And Mike, do you see a greater scope for ESG investments in Europe, given that we are seeing a fair amount of regulatory push in the Eurozone in general? Or do you think it's a trend that regulators pretty much across the globe will catch up very quickly? Where in the balance are you?
Well, I think the support that European regulators have shown for SRI has been valued and helpful, and I think other regulators will move along these lines. Indeed, we're seeing some of the stock exchanges around the world increasing their disclosure requirements on companies. But I think it's important to keep regulatory actions in context, because they can't drive demand. Right. They can only support demand or show demand that SRI is an available option. The only thing that can drive demand is the demand itself. So people actually have to want sustainable investment. Now, the people that can incentivise this are the asset managers. So we shouldn't sit back as an industry and expect regulators to create a market for us. We have to get active about communicating what's interesting and exciting and engaging about our sustainable investment products. That ultimately will have the bigger impact on demand than what the regulators do, although obviously their support is fully welcomed.
And Mike, in your conversations with investors and asset managers, where do you think investors are when it comes to emerging and frontier markets, when you compare them, let's say, with the developed markets? Are you seeing a lot of interest build up, or do you think there was a bit of interest a few years back, but due to various reasons that is starting to dwindle down a bit? Where do you think we are in the overall global context?
Overall, at the moment I'm feeling positive about emerging and frontier markets in SRI for a few reasons. I'm feeling positive because I think there is growth within the markets. So I think we are seeing in a number of emerging markets around the world, there is a nascent level of SRI interest. And that is absolutely critical. We have encouragingly moved away from a world in which European or US asset managers throw demands onto companies as to what they will expect in order to earn the investment dollars that the investors were never planning to deliver anyway. So I think that the in-market growth is encouraging. The second encouraging factor is that there are some specialist emerging markets SRI funds, and they have clear investment rationales and reasons why environmental factors in one market, social factors in one sector, corporate governance factors in another region are able to drive investment performance. So coupled with the domestic growth, the international specialist emerging markets growth, I think, is very encouraging. What remains challenging in emerging markets is the research model and the research coverage. There's no way that the economic model of research supports broad and deep research across all emerging markets. What I think we will need to move to is a much more flexible model of research, whereby there is some data availability on all companies, but there is also a responsive capacity within the research market to turn around and respond to individual asset manager demands on a time-sensitive basis. So covering all of Nicaragua doesn't work, but having a capacity to be able to dig deep into a stock or a sector when an asset manager needs, I think will be critical if we are to get the depth of research that asset managers, of course, are going to need if they're going to dig out the alpha, the local market insights, the specific issue-related insights.
Mike, one of the challenges that we've seen asset managers face is the integration of the ESG research process with the mainstream research process, so to say, right? Now, different asset managers have actually gone about this in their own different way. But in quite a few instances, this continues to be a challenge, right? What is your take? How do you think asset managers are going to cope with something like this going forward?
So my experience is, as you say, is that it's challenging for asset managers, but they get paid to do challenging. Right. They don't get paid to do simple. So I think a number of them are rising to that challenge. I think what's been encouraging in recent years is that we have seen a diversification of the different approaches to integration. So if you are a fundamental bottom-up asset manager, you need to be looking at social and environmental factors insofar as they can contribute insight and establish mispricing opportunities of individual stocks and sectors. But then you also have approaches that quants asset managers will take using statistical, indicator-driven models from deep data sets in order to be able to deliver that investment performance. I think where our industry gets into trouble is where we try to apply the wrong integration strategies to the wrong investment strategies. Right. So applying quants integration to a fundamental active portfolio or fundamental active integration to a quants portfolio, just as we get into trouble when we try to apply equity-based strategies to fixed income and vice versa. So integration is the challenge. I think asset managers are rising to it. I think what's interesting from a research provider's point of view is that as different integration strategies emerge, different research strategies will emerge and different research needs will emerge. Yeah. Asset managers will need to go out to the research market to look for different things. To pretend that's not the case is a little bit like me thinking that I can buy my wife's birthday presents from the same shop as I do the weekly supermarket shop. It manifestly isn't going to work. So I think integration is interesting. I think it's an exciting challenge for asset managers. I think it's also a challenge for asset owners because there are credible and verifiable approaches to integration and there are less plausible strategies. Right. And I think the asset owner's job is to be able to delve into which are which and to understand which are which. Now, of course, it's difficult because integration, by its very nature, is integrated. However, I think it's fairly clear that an asset manager that is basing their integration activities on difficult, intricate research is probably in the right space. And if an integration strategy is not based on research that is trying to find out things that other people don't know, it probably isn't integration.
Right. Mike, you also hold an annual independent Aries survey, right? Could you talk a little bit about the objectives of this survey?
Yeah, sure. So the IRI, or Independent Research in Responsible Investment Survey, was something that Extel Surveys and SRI Connect set up 5 or 6 years ago now. And the motivation behind it was to drive recognition for quality of sustainability and corporate governance research. Essentially, we modelled the process on the Extel survey, which recognises high-quality investment research by sell-side analysts. So we set up the survey with a view to recognising and rewarding sustainability and corporate governance research, no matter where it comes from. And that's the critical thing. It can be from sell-side research, it can be from independent agencies, it can be from independent providers. Every year we run it. We'll be running it this year in November. And last year we had over 1,000 participants in the survey. So the results of that, we are increasingly confident of saying, really do give us a sense of who's hot and what's not in SRI and corporate governance research. Of course, alongside the quality of the analysts, the quality of the research firms, we also do a lot of market research around what companies think of the SRI process, what SRI analysts and investors think about companies, about how commission is paid, about what is valued, and about trends in SRI and corporate governance research. I think alongside the idea recognises quality, what we're trying to do is just give information into the SRI research market on the basis that information always helps the market become more efficient, it helps supply understand what demand understands supply. And so the more we can do to give those results back transparently to the market, we will continue to do. And are hugely supportive, of course, of Extel's brand in this, who bring both the technology and expertise, but also the understanding of how important information is in markets, or for the efficient functioning of markets.
So we just heard about Mike's views on the responsible investing space in general. Clearly it is a space that has a lot going for it right now. It's a happening space, and with important regulations coming in early next year, there's a lot to look forward to. Please let us know what you thought about this video. You can log into our website at sganalytics.com. You can also connect with Mike at SRI Connect and let us know what you thought about the video. Thank you so much.
Thank you very much.
Thank you, Mike, for your time today. It has been a pleasure talking to you.
It's been a great pleasure. Thank you.